So the PSU banks are certainly moving up, and it ties in with what we were saying at the start of the policy as well. The market has not gone in with too many expectations, so that initial drop was just a trading drop. Right now it could well be a trading bounce as well, but the banks are certainly trading in the green right now. Ravi Uppal is with us as well, and Mr. Uppal, your initial thoughts really, I mean, but you know, there isn't too much, because neither the policy nor the statement is really giving any kind of giveaways. This will probably happen post the budget coming in.
Well, you know that I think the announcement by the RBI governor along the expected lines, you know, having given a rate cut the last month, one was not expecting him to sort of drop these rates any further. But I think if I speak on behalf of the private industry, the investment is still not coming from the private sector. Number one, the commercial lending rates still continue to be very high. And, even though the governor has reduced the repo rate earlier to 6.75%, I thought there was room to sort of reduce it notionally by another 25 basis points to acknowledge that the lending rates eventually from the commercial banks must drop. He should have also, made an appeal to all the commercial banks to reduce their rates still further. For anyone who, borrowing money from the banks at a rate anywhere between 9.5% to 12-13%, and given the kind of environment which still is very stressed and unpredictable, it's not very much investment which will come. So therefore, the private sector feels that today if they borrow the money at these rates, they're essentially working for the banks. That's number one. Number two, those who have invested money in the core sector, whether it is power, it is steel, mining and infrastructure, they still are very stressed, and they continue to have this, sword hanging on their, heads that their assets, could be declared NPAs. It was very comforting to hear from the RBI governor that they will, take a sort of generous look to see how they can help the stressed sector by not hurrying up to sort of announce them, declare them as NPAs. I think we have to have a kind of financial package for the stressed sector, because most of the problems are not unit specific, but it is industry specific, and many of them have happened because of the global trends in those very sectors, whether, for example, you take steel or infrastructure. Globally there is a demand which is in recession, and at this point of time, these all sectors need to be handled with certain sensitivity, and we need to devise some kind of, packages to address their short-term grievance.
Yeah, but I still think, Mr. Uppal, that given within these pockets as well, there will be a company-specific approach, there will be a management-specific approach as well, which the RBI indicated. Your point is well taken, but I think he clearly mentioned that in some cases, even with the change in management, there could be some remarkable results in terms of how much can these stressed assets give back as well. But I think that point is well taken from Mr. Ravi Uppal. However, let me get in just the initial thoughts of a couple of other experts as well who are joining us. We'll come back to this discussion as well. Nilesh Shah of Kotak KMC. And Nilesh, we're talking about the way forward. How do you think, I mean, we've gotten an initial policy reaction, but how do you think the RBI sees the growth going forward in the next few quarters and months, and how will that impact the policy stance from the Reserve Bank?
I think RBI has definitely upped the growth target at 7.6% in this policy. This data, there has been a lot of questions in the market whether this reflects the ground condition or not. But RBI is categorically saying that yes, this does depict the growth conditions prevailing in the economy. And 7.6% growth in the challenging global environment where your exports are slowing down is definitely a robust number. It definitely poses well for the platform which we are building up, and whenever the global growth revives, I think Indian economy will be standing out.
By the way, Aurobindo Pharma has some news bit to it as well. It's a very large market size of this celecoxib capsules, about $900 million, and they've gotten the US FDA approval nod for those capsules from Unit 7. So this should spur the stock of Aurobindo Pharma for sure. But coming back to policy, Jahangir, RBI did mention that the CPI target for Jan is likely to be met, but also stated that they'll be looking to adjust that inflation target post clarity on the pay panel implementation. And he kind of, dismissed this slight change in the Jan 2017 inflation expectations as well by 20 bips. Your view on the inflationary expectations?
Yes and no. I mean, we know that, it's going to be about, 0.6 percentage points of GDP of higher wage growth, and that we know from previous experience what kind of impact it can have on inflation. It can have a pretty large material impact on, inflation, but I don't think that's what really is bothering the RBI. I think what's really bothering the RBI is that what does the government do to offset that 0.6% of higher expenditure on the wage front? And I think that's where I think most of the questions are about the next year's budget.
Vivek, you talked earlier about the tight liquidity. Now, the issue of tight liquidity really is that one has to decide, is it a short-term tightness or is it a long-term structural tightness? How do they really draw this fine distinction? And what can the RBI do really about addressing it? Because after all, short-term tightness can always be addressed. The worry more is about longer-term tightness. And what are the equipments, what is the kind of quivers that the RBI has in its armory?
No, I think what is happening this time is that what tends to be just a very short period seasonal tightness or a short-term tightness after the advance tax payments has now become almost an embedded tightness in the system. And that is principally because government spending behavior seems to have changed quite considerably. And unless the RBI has, some information that we are not aware of, this tightness could continue for a while if the government is indeed squeamish or conservative about its, spending on different programs and ministries. So, there have been OMOs, there have been auction cancellations, but these haven't been adequate to address the problem, and consequently, people blame banks for not transmitting the earlier rate cuts and so on. But liquidity is as much a part of the equation as the signal rate, and we have now for a much more prolonged period of time than in the past few years, a period of extremely tight liquidity. And I don't think just the overnight rates, so the fact that it sort of has moved on average closer to the policy rate, really captures the situation. You just have to see the market rates where everything has moved up sharply. So even if it is construed as a seasonal thing, perhaps the RBI should have, assured the markets, and I think they did, partially in the press conference, that there would be, some action, and there could be other, measures that could have been taken, lowering of the LCR, doing something about daily cash, the CRR requirements and so on. This is a problem which is not entirely short-term as it's a one-week problem, but it's a problem that's been persisting for a while, and it's been affecting various aspects of the financial system, ranging from transmission to the cost of funds for companies. So I was just disappointed that it didn't get the attention it deserved, or it wasn't sort of identified as the earlier seasonal problem, which would go away, which would sort of give an indication that the RBI knows a little more about government spending behavior. That's the limited point I made.
Absolutely, except that I think nobody quite knows anything about government expenditure. It's purely a function of the pulls and pressures at that particular point of time. But Mr. Uppal, if I can just come to you, since you're closely linked with two particularly stressed sectors, power and iron and steel. The government has taken a number of steps, both on the power sector as well as, iron and steel. Have these measures, will they suffice to ease some of the tension and some of the pressure on the players in these two sectors? Or have we not seen the end of the day, particularly as far as steel is concerned? Because there are reports of large-scale dumping by China. And as far as the power sector is concerned, it's always out of the frying pan into the fire. But are you satisfied with the kind of measures that have been taken so far? And how hopeful are you that these two sectors will see some kind of improvement? Mr. Uppal?
Well, it is quite true that both power and steel sector are highly stressed. Government had moved in to introduce the scheme by 525, which is, has made some positive impact. But the problems of both the sector, steel in particular, are very, very serious. The magnitude of the problem that we initially thought was lot less than what is being actually experienced. You can see I can't recall any unit which has announced the results so far has shown any positive results. Even the best of the units have posted huge negative losses. And this has happened for reasons which are very external to the system. The Chinese, the Koreans, and the Russians, they continue to dump steel in India. I think the government has to introduce the MIP scheme soon as possible so that our industry, doesn't collapse, because it is now very close to the collapse. And the second thing is that they also have to offer a complete financial package to the industry, because a lot of the units had, made huge investments, borrowing the money from the bank. They are under the repayment obligation. They have to service the interest. The earnings have fallen to a very low level. Some of the units don't even have enough EBITDA to service the interest costs. And therefore, the government has to take a very practical, pragmatic, and compassionate approach towards the industry. And they should remember that India is all poised to become world's second largest producer of steel. And therefore, keeping that in view, a kind of package must be made for the steel industry. I'm not trying to say that there could be some units, where the problems are internal to the management of the company. But I'm saying if you take on an industry-wide basis, the biggest of the units who have been star performers in the past, I think we need to look at them with sensitivity. And I'm sure that the steel industry is pretty strong otherwise to stand firm on its feet. But what they need is some kind of support at this critical juncture when the global steel industry is going through a huge crisis.
Okay, which is a fair point as well. Jahangir, let me come to you. Since we are talking about what the RBI will do going ahead, Jahangir Aziz, my question is to you. Your rate cut expectations from the Reserve Bank of India over the course of the next 11 months?
Look, I mean, if the government delivers a fiscal deficit target, which is, I would say, close to 3.5, I would say there's at least 25, maybe even 50 basis points of rate cut. If the government violates that norm and comes up with incredulous numbers to come to a 3.5% deficit target, I think it is very difficult to see the RBI easing, without any real concerns. I think it might ease, but it would be in very small drips.
Okay, and Nilesh, I just want to get a market perspective here, because the equity markets are now doing fairly okay for themselves. We'll get the corporate and the economic perspective in a bit. But your thoughts on the market valuations front at the current levels, because we seem to be doing okay currently post-policy.
From a valuation point of view, obviously we have become about 15-20% cheaper than what we were, say, 6 months ago. Now the trailing basis Sensex P ratio is almost at its historical average level. So we are at the lower end of fair value rather than cheap or expensive. More importantly, we have to look at the forward earning, where there is a reasonable hope that after 2-3 years of stagnation in earnings growth, FY 2017 could be a turning around on the back of improved liquidity, lower interest rates at the borrower's end. Third, a good monsoon after gap of 2 years. And fourth, a budget which is kind of balancing revival of public investment vis-a-vis fiscal prudence. If we get benefit of all these things, then certainly earnings should recover, and then this market becomes at the lower end of fair value.
Obik, you spoke about the tightness in liquidity and you spoke about the government not spending. But how much of this has been contributed to by RBI selling dollars in a bid to prevent excessive, quote-unquote, depreciation of the rupee? And then before that, I'd like to have your final comments on the policy. How would you like to sum it up?
Right. Just to answer your first question, we have sort of estimates on, our own estimates on how much the intervention has added to the liquidity shortage. Our submission is, or our assessment is that it's more the lack of government spending, and considerably more in terms of percentage contribution, that has led to this liquidity shortage rather than the intervention, which has been quite significantly in the forward market. Coming back to my final comments, I would like to sort of emphasize one thing which is perhaps a little dissonant from what some of my earlier panel members, co-panelists have said. I think the RBI is in a sense conceding the fact that the growth momentum has flagged. It has said so explicitly, and its numbers, 7.6% might be a strong number in absolute terms, but it is just a pickup over the 7.4% that it has, a 0.2% pickup over the 7.4% number that it has estimated for 2015-16. So the RBI is looking at a very, very, muted recovery, if one can call it a recovery, given the various estimation errors involved. So I think that could bring cheer to the market in the sense that if that is indeed the case, the RBI will perhaps support growth by going in for more rate cuts, perhaps not too many more, but certainly one or two. But there are risks coming from the fiscal front, and hopefully we will get a budget that balances some of the imperatives with some of these risks.
Okay. Lovely having all of you. Thank you so much for taking the time out and being with us and giving us your thoughts on the policy. To the bankers as well, you waited by. Thank you so much for being with us and giving us your thoughts. And Maithili, as always, thanks so much for taking us through this policy. We'll take a very, very quick break.